Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
We've just been on this pathway of an AI boom. The need for infrastructure, the need for spaces that can run these GPUs, the chips that train the large language models is just such huge demand. And Iron is to the people that understand the business was the obvious case there.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How has a tiny Aussie startup turned cheap energy into explosive data centre growth? And what can you learn about the share market from the microscopic study of business practices? Thanks for joining me again as I welcome Leigh Gant back to the microphone. G'day, Leigh.
G'day, Phil. Thanks for having me.
Thanks very much for coming back on the pod. Leigh Gant is the founder and CEO at Unio Growth Partners. He's a business owner, investor and long-term thinker. He's built and exited multiple ventures, worked with wealth management firms and boutique funds across Australia, and now spends his time helping businesses grow and investors make sense of the market. He's influenced by the principles of great investors such as Buffett, Munger, Greenblatt, Miller and Lynch, and he approaches investing with the same way he approaches business, patiently and with an eye for real-world results. So we recently ran into each other at the Gold Coast Investor Summit with the Australian Shareholders Association, and I just got to say, I go to quite a few of these conferences and even ones run by the ASX and so forth, but I know we're biased, but I think they're much better what the ASA puts on. What are your thoughts?
Yeah, absolutely. Well, I really loved the one in the Gold Coast, biased being in Queensland. So I think you and I enjoy staying locally. It's pretty good. But yeah, I think it was well run and some really interesting presentations as well.
I was really astonished actually by the G-Space presentation. G-Space is a small company. It's not listed on the share market as yet. I think it will be. But in terms of rocket launch operations and actually understanding now that there's a launch pad at Bowen in Queensland, it's amazing, isn't it?
Yeah, absolutely. Yeah, I think, there's quite a few good Queensland companies here. We could make this whole podcast about Queensland if you like. It's an advertisement for Queensland.
I've been here a year, so I almost qualify.
But yeah, them and companies like Jumbo Interactive, PWR Holdings, that, there's some really innovative and very cool companies that come out of Queensland.
And I also enjoyed Michael Kemp. I always enjoy his presentations. It was funny when I first had him on the podcast, I kind of thought he was very serious. I didn't realise, because sometimes when a Zoom kind of call, you don't get the personality, but he's got such a wonderful, dry sense of humour.
He does. He is, as a writer myself, I wish I could be as eloquent and as well written as Michael, and hopefully one day I'll get there. But, he's fantastic, and the way he's really good at integrating historical lessons, like, very, very far ago history into, what's happening in the markets today or in politics. So, yeah, Michael's very good.
And what about your favourites? What were your favourite presentations and why?
Yeah, I liked, and forgive me if I pronounce this incorrectly, is it David Nord from
David Nord.
David, yeah. So, I mean, the presentation itself on what large language models and other applications can do for AI wasn't too revolutionary for me, like as some of the stuff I have seen in the past, but he made it so fun. And the audience at the ASA is obviously a little bit older. There's sort of more around retirees. So to see their reactions to an AI-produced rap song about investing, and
I think it's the first time they would have heard of Hilltop Hoods.
Yeah. So that was really good. But it also, there were some of the applications that started making me want to play a bit more with different models. Shane Ellis was really good as well. Another non-boring presentation. So the topic was tax strategies and retirement strategies and SMSFs, which isn't, the most thrilling theme, but the way he made it interesting was really good. But yeah, I find obviously Australian tax system and, the lengths we need to go to ensure that we can keep what we earn and what we grow for ourselves really complex. So anyone who's out there helping, demystify, the tax strategies and how to utilize the SMSF structure, they're incredibly valuable. So yeah, Shane did a really good job.
So are you using AI in any ways with your operations these days?
Yes, I do, in multiple different ways. And I'm always trying to find new ways to use AI. So I have it integrated into my calendar to try and optimize my time. I think I've got 5 email addresses. So I use a tool that sort of syncs it all and organizes and categorizes my inbox, which really helps me keep track of things. So from something like an everyday application like that to, where I use and have developed my own AI board of advisors. So I've sort of trained a model on ChatGPT to help me with sort of business decisions. And that took a while. I put a whole heap of input into it, but it allows me to get, sort of lateral views on what I'm thinking in operating business just from, chatting to a make-believe board of advisors.
I know, it's incredible, isn't it? They're just using it for something like that. I mean, I've recently decided to institute a mission statement, which I've never done. And then sitting there and chatting, I use Grok, and chatting about that, it really focuses your own thoughts, doesn't it?
Definitely. I don't think I'm using it for any way to replace what I do or any of my output, but the way it's able to synthesize and get clarity from what I'm trying to do or thinking about is so valuable.
And I think we're both of generations that still believe that there's something special about our human brain and what we can do, and because we want to write under our own steam.
Yes. Well, at the same time, I think that all the different models produce a lot of slop. Like as a writer, I find it very easy.
It's awful, isn't it? When you can just tell it, can't you?
Yeah. Oh, it's obvious when someone hasn't put a personal touch on AI produced content. And we're going to talk about businesses that are there at the AI forefront today. But I find myself, debating whether we're on the precipice of white collar jobs being totally replaced because they're just a function of compute, or are we actually very far away from that because what is coming out of the models right now is actually not that good.
I know, I saw recently a video on YouTube, and it was an investment video. Obviously, the whole thing was done by AI. And like you said, it was slop. The content was slop. It was just about how to invest in the share market, and didn't give you any actionable insights, didn't really go into any depth. And I looked and it had millions of views. I'm thinking, who's watching this crap?
Other AI bots are watching it. It's
okay, that explains it.
A loop of AI bots and tools just cycling through. So again, that's you can play a game there where obviously if you start something like a YouTube channel and utilize these AI tools to produce the content and optimize it, it will then get the views, but the views are probably coming from other AI tools. However, you still get paid on views and things like that from YouTube. So I'm sure someone's out there doing this AI arbitrage and making a killing.
Okay, so one of the great beneficiaries of AI are data centers. And I just wanted to refer to a recent article that you wrote about IREN and this fantastic company, which I believe it's on the NASDAQ, and it's an Aussie startup that is now worth more capitalisation-wise than the whole of the Australian Stock Exchange.
Yeah, I'm not sure about that. It would definitely be ASX top 20 now, and it is run up an incredible amount in a short amount of time. So it is a great story. We were talking earlier offline about, how good it is to support Aussies doing well. I'm very biased towards this company because it's Australian. I mean, it is doing a great job. It's executing very well, but, a soft spot for local guys killing it overseas.
Yes, I know. There's plenty of times when I'm interviewing people in the United States using Rode microphones, and I proudly point out, oh, well, that's an Aussie company, and they actually manufacture here, not even in China.
Wow. I didn't know that. That's fantastic.
Yeah. No, it's a great, incredible success story. Private company, family owned, and very, very tightly held.
Yeah, superb.
Ditch the spreadsheets. ShareSite is Investopedia's top tracker for DIY investors. Invest smarter, not harder. Grab 4 months free on an annual premium plan at sharesite.com/shares for beginners. Okay, so tell us the IREN story. Who are they and what do they do?
Sure. So, as we mentioned, IREN is founded by a couple of Australian brothers out of Sydney. Their background is actually infrastructure from Macquarie. So, obviously have a good background immediately. And the starting is not in AI, which we'll get to. That's more of a recent pivot. But the brothers sort of uncovered, what was going on in the Bitcoin space in sort of the mid 2010s, sort of 2013, 2015, and got really interested in that space. So the thesis around building out a company to mine Bitcoin, not just IRENs, but perhaps others, is on a hinge point around power. So for those that don't really understand Bitcoin mining, I'll try and simplify it and bastardize it in the process. But essentially you need energy, obviously, because the compute to mine Bitcoin, it requires a lot of energy. And so one of the knocks on mining Bitcoin is that not only does it demand a lot of energy, that's not a very clean thing to do. So, from their infrastructure background, they wanted to build a business around this paradox, right? Clean up by cleaning up Bitcoin mining. They traveled the world looking for, how can we find, cheap energy that's clean? And so finding, stranded or wasted renewable energy in places like hydro-rich Canada or, mining offshoots in British Columbia, that sort of space allowed them to get that sort of cheaper energy, but also utilize it from a renewable point of view. So like power is the commodity and then infrastructure is the moat. So unlike sort of some of the businesses now that are clamoring for data centers, IREN is vertically integrated, meaning that they sort of own everything from construction to endpoint, getting the land, doing the construction of the data center, owning the power, etc. So it's not very speculative because they were able to mine the Bitcoin quite profitably. But that's not really the true story now. So they've pivoted from being an exclusive Bitcoin miner to being what's now known, it's a bit of a catchphrase, is the Neo Cloud. They are an AI data center provider. So they've got this world-class capability across multiple data centers, and they're able to utilize that not just for mining Bitcoin, but to be able to essentially rent out the space for AI compute. There's a lot to go on around AI, but I guess the key factor to understand what's really fueling a run-up right now, and you'll see it in headlines because the biggest companies in the world are making all these deals to try and get their hands on data centers and compute, is that there's just like the run in demand for compute is outstripping what's actually available. So, just to meet current demand, $500 billion US needs to be invested in data centers per year until the year 2030. And that's just on current demand, right? So that is just almost untenable because where's that money going to come from? So companies that can provide the data centers and already have the compute there is like a quick and easy win for these major companies like Microsoft, Google, etc. And that's where IREN finds itself. So we first invested in IREN as in Unio, and Unio, my company, is like the world's smallest family office. It's myself, my wife, and a small team that work with us in our businesses, but really the investment team.
A couple of pets, hey?
Yeah. And an 8-year-old and an 11-year-old. They're also on team. But yeah, we saw, sort of in 2022 when Bitcoin's price had come down a lot, all the Bitcoin proxies like the miners got absolutely slaughtered. So, I think the IREN share price at the time went from something in the low 20s right down to under $2. Everyone was getting smashed in the technology space at that time as well. It was a pretty big drawdown. Like, Meta, for example, went down under $100, and that's sort of now up 7-8 times from that point. But yeah, these smaller Bitcoin miners got absolutely slaughtered at the same time. And they were just essentially too cheap for something that's, profitable and has a long runway ahead of it. So that was the initial investment thesis. But when this pivot came in, it was just obvious to us that like this was the pathway, especially as sort of ChatGPT released, end of 2022. And then we've just been on this pathway of an AI boom the need for infrastructure, the need for spaces that can run these GPUs, the chips that train the large language models is just such huge demand. And Iron is to the people that understand the business was the obvious case there. So I think from the absolute lows to today, it's probably up something like 60, 63 times. For us, it's, we didn't have our investment at the absolute low. We've sort of been trickling in from near lows to sort of not near recent highs, but towards the end of last year to build a meaningful position. And the returns have been quite handsome.
Fantastic story. And it's on the NASDAQ as well, isn't it? That's where it's listed. And it's pretty easy to buy US shares these days as well, isn't it?
Yeah. Obviously, this is not a recommendation to buy. You do need to.
No, of course not. Sorry, I should have said
that. The valuation, but yeah, I think it depends on your view on valuation. But looking ahead, for example, Microsoft has announced that they cannot take on as many Azure customers as they would like because they're limited on compute. Building out data centers to increase compute is obviously costly and timely. And, NVIDIA's made deals with Iron already. In fact, the CEO of NVIDIA was on television just 2 days ago mentioning that Iron's one of their key partners. But any company that requires compute can see that Iron is, already scaled and ready for that deployment. So they're going to come looking for deals. And so I mentioned there's other companies that have done a very similar pivot. There's a company called Cypher Mining that's done essentially the same thing, not quite on the same scale as Iron, nor with the renewable energy, but they have a deal with Google, for example. So yeah, we're very lucky that we're in the right place at the right time.
And what about the convertible notes fund expansion that's coming up?
Yeah, so I mean, it is great to see good management of companies in any sector where if they need to raise capital for scale and growth, they do so when the share price is at all-time highs, not at lows. So Iron has just announced convertible notes for, I think it's about $835 billion US. And it's institutional only. So if it does go through, it is dilutive by about 4% at the conversion point. But I guess most people would first reaction would be, oh no, they're raising and it's dilutive. That's no good. But they see the need to scale quickly. That money is exclusively going to be used to scale the AI side of the business. They already project, the revenues that it's going to be generating from their existing space to be, at least another 500 million next year. So being able to, build out more capacity is going to be very lucrative for the business. The price at which it converts is not till 2031, and it's about double from where the share price is now. So it's not going to be converted, that debt, unless, the company is going exceptionally well. And as a percentage, those convertibles are, far higher than, say, a recent raise by Tesla. So I think it's pretty good. And, it's only 2 days since the announcement and the share price is already back to all-time highs, which is an indication that it's got a lot of momentum and a lot of sentiment. But also, I guess, for the rational people, they don't see a need to jump off the wagon, really, when the company's raising. So I do think it's good. I'm excited to see how big it can get. I'm very conscious around valuation. As I said, I'm not buying now. We bought quite a while ago. So we'll see where it goes. But yeah, the demand is insane and they've got what people need.
Now, Leigh, I can't let you get away with using a piece of jargon and not explaining it. What's a convertible note?
Okay. So essentially it is financial jargon for a debt instrument. So anytime a business, whether it's your local gardening business or AI company that needs to raise capital to, maybe it's to scale their business, to grow their business, or to essentially cover maybe their outgoings because the business is not going well, one way or another, they need to raise debt. So one way of raising debt is obviously to dilute investors and increase the share count. So put out more shares and attract investors one way or another. So it's an equity raise. Another way of doing it is essentially by using debt instruments like bonds. So a convertible note is similar to a bond in that you are borrowing money from said investors, and at some point that can be converted. So converted, it can be converted, into cash, or it can be converted into shares in the business. So this particular case, it's at the discretion of management how it can be converted at the end of the period. So the end of the period is 2031. And in this case, it can be converted into shares in the business. And that's where it becomes dilutive. They need to essentially create more slices of the pizza to reward those who lent them the money to expand in the first place.
Fantastic explanation. Thanks very much for that. Always love to do that.
Sense, but
it does. Very much.
There's plenty of jargon out there, and that's I always like to think of. I mean, bonds is actually even more complex in terms of language than anything.
I know, and how to value them, and when they go up and when they go down, and interest rates, and it's amazing. But it's just interesting in terms of this, and talking about the use of capital. I know we're going off on a side path here at the moment, but I've been reading about, for example, the share buyback by GYG, Guzman E. Gomez, which has attracted a lot of criticism. They're saying, well, why are you buying back shares when they're expensive rather than cheap? And if your business model is so good, shouldn't you be using that money to be creating more stores? So, understanding and looking at the way companies use capital is really intrinsic to valuing companies as well, isn't it?
Definitely. I'm not massively knowledgeable on GYG. I have had a few of their burritos in the past, and I'm not a shareholder. But you can understand why perhaps shareholders would be disappointed that in this case there's a buyback when, it's up to management. Perhaps management are of the view that shares are not expensive at the moment and that the valuation is not exuberant, and perhaps that is the best use of capital. But I guess many would disagree with that, especially, if they're relatively early in their journey and don't have a massive global footprint and accelerating earnings. Perhaps, a buyback's not the best use of capital.
Okay, Leigh, so tell us about Unio Growth Partners and investing in micro businesses, and how many laundromats do you own?
Yes, well, Unio, our business is very, very different to own. We are not on the edge of AI and data centers. We're far, far more boring than that. And we're not raising capital either. So earlier I mentioned it's like the world's smallest family office, and that's how we like to think of it. A family office is, an instrument to look after family capital. And we, have spent our careers, my wife, she's quite successful in her own career, and I've built and exited a few small businesses. And, we wanted to have a vehicle that we could invest in both listed markets and private markets and see essentially what we could do. I mean, obviously I'm a massive Warren Buffett fan, a real fanboy, and, dreams of being like Berkshire Hathaway are probably unrealistic. But if you understand the company, Berkshire Hathaway is a vehicle for Warren to have capital to constantly compound. So they have private businesses, they have listed businesses, and he's looking, conversely to what we were just discussing, always looking for the best place in his mind as to where the capital can compound. So, Berkshire's participated in share buybacks, and at that time, Warren's discretion was that was the best use of capital to compound. How can I get the best rate of compounding from the capital that we have? So we invest in micro businesses because of our size. We're very, very micro. We are not Berkshire Hathaway size nor anything like it. But, I have a passion for small businesses after obviously building and running my own small businesses. And there are a lot out there in Australia. It's the backbone of our economy. There's, millions of small businesses. Not only
and small business is the largest employer of Australians, apart from the government, I believe, at this stage. But
the government's doing its best to catch up. But that's exactly where I was going, right? Like it is the backbone because it employs so many people. And I find there's nothing greater than going down to my independently owned cafe and having help around our house with independent tradies and things like that, not, massive conglomerates. These small businesses that people have put, blood, sweat and tears in to grow and operate, hold sentimental value to the owners. But also, there's plenty of successful ones, regardless of how tough the Australian economy and the business environment is.
So, Leigh, give us some specific examples of companies that you've invested in and are helping to build.
Yep, for sure. So Unio works as, 3 different tiers, or like a 3-spoke flywheel. We have a contracting business where we work and partner with other businesses to help them grow, specifically working within marketing, sales, and helping them with their tech stack. So making sure that businesses are not overspending and not underutilizing the right tech stacks to get their operations, sales and marketing going in the right direction. That's one arm. Then we actually invest in private businesses. We have actually recently exited one of our holdings. So we did own a marketing agency. We have exited that after acquiring it a couple of years ago. It's a successful exit and that's been moved on, but we now actually still work with the new owner of the agency, and that is a roll-up of multiple agencies. I'm not industry specific in anything that we would like to acquire, whether wholly or as a part share owner in private businesses. It could be anything. So it just needs to be understandable to us. We need to like the business, and we can talk about, what that actually means, but we have to like it. We have to understand it. We have to value it and want it to be part of our holdings. And then the third and final wheel is our listed or on-market investments. And so we like to take, as much cash flow as we can from the other two parts and invest it. And then, like I was saying about Warren Buffett and other great investors, if you've got these different engines running that can compound and you've got cash flow, it's a real luxury. You're trying to, put the cash where it needs to go or where it should go to best compound at any time. So, like, what kind of businesses do we like to invest in privately? They have to be really simple. Like, to own something like iron, like, I find that I understand it, but it's complex. I don't think I could be the CEO or anywhere close to that of a company like iron. I'm a happy part owner in it as an investor, but could I operate that company? No way. So it has to, make sense with our professional backgrounds, and also just be, something that's really durable. I know we've just had an exit, but we are looking for companies that we can own for a long period of time. One of our friends and we helped on this deal, has just bought a gardening business, but for large properties like acreage and commercial clients. That's a great business. Like, it's very undisruptable. It's got a great base of clients, recurring revenues, like all the systems and processes are there. The equipment is well looked after, all that kind of stuff. And it's got a good team already in place. That's ideal for someone of our size who, needs to have the ability to, not work in the business every day, but also, still be familiar with the operations, so that if we do need to step in, we can. Businesses that are more complex or larger, where we can't step in and we can't be helpful, is not really appropriate for us.
So you don't have to go out there with the chainsaw to help out.
Well, yeah, I don't mind doing a bit of physical labor, actually. Like, that would be really good. But yeah, if someone's going to, need me in the deal room on some complex data center, deal, then, I'm not the right person.
So when you're looking at these businesses, is part of the criteria the fact that they're missing something, perhaps that they're not marketing to their best abilities, or that there's been changes which they haven't recognised, which you can then help to grow the business? Is that part of the dynamic that you're working with?
Yeah, I think definitely in the businesses that we partner with. So our consultancy, we call it a growth partner, because we're literally there to partner with the business and help them grow. We're not going to be employees. We're literally going to sit side by side with you and work with you to achieve your growth goals. I think that's definitely the case. We will speak to potential partners about what they've done to get to the size that they currently are, And if there's gaps missing that we know we can fill and take them to the next level of growth, that's a perfect marriage. That's exactly what we want to do. And we're doing that mainly in the finance space at the moment. So we work with some boutique funds and like investment platforms, education platforms, and wealth advisors. So, a business that's sort of around low seven figures, they've already gotten out of that startup phase, but they're probably hitting a plateau where they can't actually have, a chief marketing officer and a head of distribution and all those sort of leadership positions, as well as a fulfillment team. And we come in and say, well, we can do, that at a fractional level until you're ready to employ, people at all those positions and accelerate you through that growth without you spending an arm and a leg and making all the mistakes that everyone normally does along the way. For acquiring businesses, though, we actually don't want to be in that position. I would actually say that's kind of a red flag where they haven't figured out how to have stability in earnings growth. It doesn't have to be an enormous earnings growth for a business that we acquire. We just want to have stability there because we're looking at buying something that's more mature and set up so that we don't have to go in there and do heaps of work. I think that's something I've made a mistake for in the past where I've been an owner in a business and it's essentially a turnaround story. Like they don't have their growth taken care of. And I know that I can help in that space. However, that's not a really good investment decision.
You want it to be far more turnkey. Is that the case?
Yeah, definitely. I think the less renovations we have to do to the business, the better. And I think I've got a long list of mistakes and things that I've made in business that I've now taken as a playbook to learn from, and a whole bunch, or there's a podium of errors that I've made, and essentially they form the case for my red flags, amber lights when I'm looking at businesses to acquire or invest in.
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
And there's many great businesses that are available now because the owners are retiring. They were built by the boomer generation. The kids, they're ungrateful children, don't want to have anything to do with the greatness that's provided for their well-being. And that this is a real process. Actually, this came up, I didn't actually see the presentation, but Sebastian Evans, who's got some listed investment companies with NAOS, who presented at the conference, that's one of his playbooks, is finding those kind of businesses that need to be passed on and handed to another generation, not necessarily their own one.
Yeah, absolutely. I mean, that is definitely where we want to go fishing. I think there's a case to be made that, those companies deserve to keep going. There needs to be a steward for those legacies, which makes us sound holier than holy, but I do believe in that. Like, these are great businesses that have served their communities or have great growth stories over a long period of time. And to be not critical of the children of these owners, perhaps they're just not interested in those businesses. I know for one, my children are not interested in the businesses that we work with. So they're far more interested in their own things. They're a bit young that I can convince them surely. But you don't want to see those businesses just disappear. The other thing I think is quite interesting is that a lot of business owners either just don't know they can sell their businesses, or they think of selling their businesses too late. They suddenly wish to retire and the businesses aren't built to sell. So whilst maybe, clearing up growth issues is a red flag, if there's businesses that come to us or I can discover that don't have systems and processes and operating procedures all sorted out and have the opportunity to remove the owner from day-to-day operations through smart hiring, a little bit of technology, and perhaps better org structure, that's really interesting. So it may impact earnings in the short run while you're restructuring the business a little bit. But if you can prove that it will be then stable for another 10, 20 years without the owner in the business all the time, that's the potential essentially for a bargain. because a valuation, needs to include obviously how easy is the company to run. And yeah, I've definitely seen a lot of businesses where the owner is still stuck in working in the business rather than on the business. And they suddenly wish to sell and they go, oh, this business is not an asset. It's currently a job and I need to transform it into an asset so I can sell it. And I think that would be the ultimate sweet spot, is to find a really desirable business that's going to come to us asking for help to make it built to sell. And I would say, well, I could be the suitable buyer after we complete that job.
So give us a specific case study of a business that you've acquired. It'd be really good. I think it's a great learning to understand businesses as how they operate. And, we can apply this to our investments in the markets as well.
For sure. I'm really happy to use the company I already mentioned that we recently sold. We exited. Exited is the fancy private equity way of saying I sold the business.
This is the marketing agency, is it?
Yeah, it's the marketing agency. So to begin with, the way in which I first started looking for businesses to buy, private businesses to buy, was essentially getting as many IMs, information memorandums, as I could from business brokers and just analysing them. So an information memorandum is essentially a booklet with basic details about businesses for sale. So you can see very high level things like what the business does, how it operates, perhaps the last 5 years of revenue, and maybe a few specific sector related items about the business. So it's not really deep, but you can essentially do a little bit of analysis, a little pre-due diligence from those to see if you're interested. And I hadn't bought a private business in the past. I'd sold businesses, but never, gone through the process of buying it. So when you become a self-directed investor, you're not perfect from day one. You've got to put in the reps, and you might look at hundreds and hundreds of potential investments before you make your first one. So it's very similar with a private business. You've got to get the reps in first before you go out and buy one.
I suppose you need an understanding and a feel, don't you?
Yeah. And after, if you find a business just from looking at information memorandums, you don't just put an offer in and buy the business. So there's quite a process from there. And the first step is to then go and find even more information about that business before you meet anyone or talk to the broker. So I was essentially doing it as a mental exercise to prepare myself to at some point buy a business. Except in this process, I came across a small marketing agency that really spoke to me, because my background at the time, I've had a few different jobs, but I have worked in marketing a bit, and I was the chief marketing officer at the time for Australian Shareholders Association. So this marketing agency was quite small. It worked with financial services, so financial planners and accountants, and it had been for sale for a while, and the asking price had dropped over a couple of years. And I was looking at it, and it was a retiring owner. Financial services makes sense to me, having worked in investing for a while, so I spoke the language, and I've got the work experience in marketing. So I said, this is pretty interesting. So yeah, I just accelerated through that process and ended up buying the company. It took about 6 to 8 months to go through all my research, due diligence, and agreement on price and all that kind of stuff. We can skip those details now, but yeah, eventually I bought the business, and it had key things at a high level that I was looking for. Retiring owner who wanted to exit, so that reduces some of the risk from competition and things like that. Like if the owner wants to get out and then go and start the business again with a different name, that's a bit risky. So
no need for a non-compete clause, huh?
Yeah, which is actually really hard to kind of enforce as well. So, just because it's written down doesn't mean that it's actually very protective of your business. But yeah, retiring owner, it was very profitable. When I went through due diligence, I understood that there wasn't really any standard operating procedures. It was kind of all locked away in the owner and the team members' heads. Like they'd been operating this business for so long that it was just automatic to them, like how to do the execution of day-to-day operations, which is not great for scale. And like I said, that's not really a sellable asset. You need to have, not only like project management software and things like that in place, but also literally how to do the jobs, who does them, like step-by-step checklists of how to do things. And none of that really existed. So for a lot of people, that should be a red flag. But for someone like me, I go, I'm really good at developing those and I know this space. I can put that together and we can scale this business really quickly. So we took it over and immediately that was my first priority, is to obviously settle into running the business, but at that same time develop the backbone of administration and operations so that we could scale and take up the opportunities that were out there. The retiring owner had essentially put the brakes on any growth over 2 to 3 years because she wanted to exit. She wanted to get out. She wanted to retire. She wanted to, spend time on the beach or whatever it was rather than running her business. So she wasn't taking on new clients. I knew that we could grow it just from my own network. So I was really happy to do that. Of course, not everything goes to plan. I'm a very big optimist when it comes to business, and it's
you have to be, really, don't you?
But perhaps I was a little bit too optimistic because, it was really, really hard work. The first 6 to 8 months was super hard. So getting to know team members, restaffing after, people moved on from the business, setting up that admin and operations backbone. There was a lot of me working with my hands on the tools rather than, working on the business from the top. I was in there doing the work. So that was quite challenging, but it paid off. We did end up growing the business. We did end up bringing in a really great operating team. It was very efficient. So not only did we grow revenue, we grew the margins. So that's, like throwing rocket fuel on a fire, right? Like if you can grow the revenue and improve margins of any business of any site, you're essentially, there's a lot more coming to the bottom line. So that was really good. And it was a roller coaster internally and lots of long nights on my behalf, which was really difficult, but it sort of paid off. So within a year, I personally was already receiving offers on the business because within my network, people understood what I was doing, and I know others who are setting up roll-ups. So a roll-up is where you buy a similar sort of business over and over again so that you can form one large group of businesses. So it could be childcares, it could be marketing agencies. It doesn't have to be just one sector, but you're buying the same sort of business over and over again to create one large business of that sort. So a few marketing agency roll-ups, essentially asked me, are you interested in selling? And initially the answer was no, because I'd just done all this hard work. But at some point I thought, well, you got to take the opportunities when they come. And that's what happened recently. And we exited from there.
Wow, fantastic. Congratulations. It's a great story.
Thank you.
So what are some of the things, or maybe just one thing, because we've got to wrap up the interview now, we're just about to go over time, is what's something that you've learnt from operating with micro businesses that you apply to your share market investing?
There's probably a couple of risks that I put more weight to now. One of those is customer concentration. So if you are looking at investing in a bit like a service style business and that business has a list of customers, so regardless of how many customers are on that list, if there is a single customer that makes up a large percentage of revenue, maybe it's 20, 30, 40%, that is really good in that in one way is that your potential investment has the trust of another client and they're making lots of money from that client. But it's a massive risk because if that client moves on, you suddenly see that 20, 30, 40% of revenue disappear. So you have to be really wary of companies that say, oh, we've had these clients for years. We're so good. We've got all this trust and deep relationships with our clients because our average lifetime engagement is 7 or 8 years. Whilst that is great, but if there's a risk from one of those clients leaving, even on good terms, the destruction in revenue is scary. So that's one thing. Key man risk obviously if, you have a business where the founder, CEO is integral to the business and then, maybe something bad happens and they, suddenly can't work in the business anymore or they want to retire or something like that. I've put more weight in that recently after seeing, how not in a business that I actually own, but I'm sorry, a friend's that I've seen him having to quit because of health reasons and that business just falling apart really quickly. So I would be really conscious of key man risk. On the other side, if a company is really well managed and built as an asset, even if there's a person like Warren Buffett, who's obviously the face of Berkshire Hathaway, it can still operate exactly as it is without Warren in charge. Yes, it's probably going to miss some of the magic that Warren brings, but I don't think the operations of Berkshire Hathaway are going to change too much without Warren being at the helm. And there's actually an even more recent example from a large serial acquirer, a very well-known finance bros company in Constellation Software. It's a acquirer of small software companies. They've made over 750 acquisitions over the last couple of decades. And that CEO and founder, Mark Leonard, just retired on health reasons. And the share price dropped quite a lot in a very short amount of time. I think it was its biggest drawdown ever. But I guess what most people miss is that the person who's taking over Mark's position has been with the company for decades, and the company is totally built to run without Mark Leonard in the driver's seat. So, if you picked up shares at the very bottom tick there, you've probably done really well, because I don't think it's going to make a huge impact without Mark Leonard as CEO. So those two are the big risks that I would look for to avoid, I guess, in listed markets in the future. Any positives that I would look for? Probably not. I just think it's so crucial to really understand the businesses that you're investing in, whether it's private or listed markets. You just have to really understand the business, because looking at what the share price is doing tells you nothing about the business itself. All it does is tell you about the action in the auction market, that is, the share market or private world. You've got to understand every little bit of the company and how it operates if you want to be an investor in it.
Yep, it's not easy investing directly in the share market. You actually do need to put in the work, don't you?
Yeah, well, Charlie Munger says if you think it's easy, you're stupid. So I like to think I'm not stupid.
So if listeners and viewers want to find out any more about you, where can they find you?
Yep, you can visit uniogrowthpartners.com. We're actually about to restructure uniogrowthpartners.com at the moment, where we're going to, as I said, we've got 3 engines and we're going to split them up into their own digital spaces. You can wait for that, or you can find me on LinkedIn. I also write in a number of places on the Motley Fool, Rask, Team Invest. You'll find my name behind some articles everywhere. So just Google me and reach out. I absolutely love talking investing, whether it's private markets or listed markets. So if anyone ever wants to chat, you'll find an ear in me.
And even sometimes lurking on X as well.
Yes, I don't like to do too much on X, but I get impulses to start chatting back and forth. It's a very noisy place, X, but there's some true gems on there. And if you're able to filter all the rubbish and to uncover gems, you'll do well on X. But if you don't like noise and you don't like lots of people shouting at each other, maybe avoid X.
Great investing advice. Avoid X, unless you're getting some gems out of there, which you can. There's some great people there that you can follow as well and get some information.
For sure. I totally admit that I have found investing ideas through X, probably more now going off onto places like Substack, where writers are able to explain themselves deeper. But yeah, I think, there's still really clever and great investors that spend time on X. But you have to have a really good filter, like a personal filter, to understand what's true, what's not, what's noise, what's signal.
Leigh Gant, thank you very much for joining me today.
Thanks, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.